Hey everyone, I'm Jeremy Szafron. This is Kitco News. Well, commodities have had a roller coaster ride over the past few weeks. Spot gold surged past 26.30 US dollars an ounce, setting fresh highs, while oil is facing a different struggle, hovering around $71 as weak demand from China continues to loom. Add to that the latest 50 basis point rate cut from the Fed, and we've got plenty of moving pieces here. Are hedge funds fueling these rallies and declines? Is China's economic slowdown the anchor holding down crude? And with the Fed's continued easing, how will commodities react as we head into the final quarter of the year? Well, to break it all down, we got our friend back, Mike McGlone. He's a senior commodity strategist at Bloomberg Intelligence. Mike, thanks again for joining us today.
Hello, Jeremy. Thanks for having me.
Like I said, my friend, it's been a crazy couple of weeks for commodities, hasn't it? I mean, let's start with a quick update. What's been happening across the commodity space right now? What have you been following?
Well, overall, I look at it as a high price cure. It's basically about gold beating everything. You mentioned crude oil. Crude oil's had a decent dip into a 60 handle. It's down 20% on a 1 year basis. And crude oil's up about 35%, almost 40% on a 1 year basis to September, 23rd. And that's a trajectory I expect to continue. And I think the bottom line is it's really what's happening on a global basis is China. The Chinese government 10-year note yield at 2.04% is 170 basis points, below the U.S. So is severe deflationary forces out of China. And you mentioned the Fed has started to ease. The good news is that might be good, but typically it's bad. If you look at the history, just look at the last time the Fed started an easing cycle, it was actually 17 years ago. On September 18th, and a year after that, gold was up 20% and the stock market was down 20%. So hopefully it's different this time.
Yeah, hopefully it's different. Okay, well, definitely have to talk about China here in a moment, but let's go back to gold for a second. Hitting that 26.30 an ounce on the spot side, I mean, it's been on quite a run, and you've noted that before gold outperforms in times of volatility. But, we're starting to see inflation cooling and the recent Fed's cut. What's driving the strength? I mean, is it hedge fund positions behind some of the price action that we're seeing?
Yeah, so you've seen that. The managed money net positions, hedge funds and futures are about 40% net long, which compares that to the peak in 2011, which is 49%. So they're very long. I mean, but they're on board and they're about as sold out in crude oil as they've ever been, petroleum futures. But that's the trajectory. The key thing that's happening, I think, in gold is gold ETFs, which have been in pretty significant outflows since that peak in 2020, about 30 million ounces of outflows. Now it's turned back upward. So we might see a little bit of excesses in the hot money, which makes sense, but there are excesses in terms of where the trends are going. That's gold going up and crude oil going down. But I think the key risk we have now is this rapidly advancing U.S. stock market just having a little bit of back and fill. And we do have an election coming up, and it's not for certain that it will be that clean and clear. Remember, the contender has never really accepted the last election, and there was some violence and insurrections after that attempt for a peaceful transfer of power. So the market might be pricing a little bit of that in. But my bottom line is gold is a bull market. It's overdue for some bucking, which means it might drop to $2,400 an ounce. But I think it's just a matter of time it gets to $3,000. And I'll end with this. A key thing and key fact about when you enter potential recessions, and particularly when you have extremely inverted yield curves, I look at the 30-year bond versus the T-bill, still very inverted. And typically when you have gold that is such a premium, the stock market, S&P 500, such a premium to gold. Just put the per ounces of gold on the same scale as S&P 500, which is basically it takes 2.2 ounces for gold. Historically, it's one over time. When you have such a premium in the stock market, they just kind of typically invert. I think that's what's happening. We just haven't seen that weakness in equities yet.
Yeah. No, we haven't. And it's been fascinating to watch as it continues to rile up here. Go back to those hedge funds, because if they're very long in gold futures, does that introduce any risks to the gold rally? Like, do you think that these funds are reading the macro signals differently or maybe correctly here?
I think the latter is more likely correctly. Obviously, they're seeing what's going on in China, plunging bond yields in China, the inverted yield curve, U.S. 10-year note yield at 373. It's still well below Fed funds, but they're legitimate positions. But the way to think about it is they're on board of significant trends. And they are, when you have, it's basically the equivalent right now in managed money net futures positions is about 25 million ounces of net longs. If there's a bit of a risk, like remember when 2008 hit, gold was up about $1,000 an ounce, it dropped to 700, and then it rocketed towards 1900 by 2011. We have risks of hitting stops in gold as people, have to sell what you can, but that would be a short-term blip for a longer-term bull market if it happens. So you have to be aware that if you're looking to get way overweight long at gold at these levels, you have to be aware of a little bit of liquidation risk. But overall, to me, the trend is quite bullish. It's kind of things you expect in a bull market.
Yeah, and people certainly not as scared to take profits too. It's nice to see that they're long. Okay, let's switch over to oil. We're seeing WTI hover around that $71 US mark. Obviously, there's this concern about weak demand in China. We've had you on before. You've said that, crude could revert back to $40 in this cycle. Do you think that the current geopolitical risks, like what's happening in the Middle East, might change that? What are your thoughts here, Mike?
Less likely. There's one thing I want to own, and that is I do expect crude oil to get down to 40. If I'm wrong, people know who to blame. I've been saying that for 2 years. And that's just part of studying the history and having traded through plenty of invasions and wars, particularly when Saddam Hussein invaded Kuwait and oil popped to 40, which is shown as a legitimate, that's kind of a pivot price. But what's happening now in oil is completely predictable based on things that we pointed out 2 years ago, and that is the high price cure is kicking in. Typically, oil has to get kind of cheap after getting too expensive. Now we're seeing that excess of supply and demand out of Canada and the U.S. accelerating. It's around 6 million barrels a day. To put that in context, around 2019, it was only 2 million barrels a day. And in 2008, when oil peaked, there was about a 10 million barrel a day deficit. At the same time, we've seen rising spare capacity to OPEC and potentially peak demand and declining demand out of China. And to me, that's significant. It's that, market had pricing for so much of that Chinese demand, yet President Xi and President Putin's unlimited friendship maybe shifted the world order. And it certainly shifted the world away from doing anything they can to do business with China. So that's showing up. All the data we see on a terminal lately for China is that property crisis is bad as it was in Japan and just starting to revert. So I look at crude oil as a bit of just doing what it normally does. $70 a barrel, still above the US and Canada cost of production, around 55, 60. You typically have to get below those levels. So I'm looking for 40. And, again, hand raised. If it doesn't happen, you know who to blame. Timing's a hard part. But that's the key thing I think is going to continue. One thing we know over time is that ratio of gold to crude oil should continue to rise over time, and I fully expect that, not without bumps in the road. But the key risk, I think, now for crude oil is we get a little back and fill beta. See that U.S. stock market just, it's up 34% total return on a one-year basis. Let's say if it drops back 10% for the election, would be nothing in the big picture. But the market, I think, would take it as a shock, and that would usually means typically when S&P 500 backs up 10%, crude oil backs up 20%. It's usually about double the volatility.
What about the hedge funds here? I mean, are they undersold in crude oil futures? Could this create some type of a surge of sentiment shifts, or are these just fundamentals like you talked about?
Yeah, the excessive shorts in the grains has been spot on for about 2 years, have been been covering those shorts in the grains, boosting up corn and soybeans and wheat a little bit, but they're looking for the next targets, and they've been way shooting at just hitting bids in petroleum and crude oil, most notably Brent. Brent futures, for the first time in our Brent managed money net positions, i.e. specs, for the first time in our database since 2011, got short about 12 million contracts just a few weeks ago. Now that's keeping a little bit of a bid under Brent. They've lightened up in those shorts a little bit, but I look at all the petroleum futures, there's about 6 of them, and they are the most sold out in our database. It's basically zero. Open interest is about flat. Not flat, but the shorts are about flat. We've never seen that. So they're sold out, but for good reason. And that's what I like to point out is I just published on that this morning. If the stock market goes down, it's much more likely that crude oil and copper will go down. I mean, they're the most macroeconomic sensitive commodities. And gold will go up, maybe in the short term. But the difference is copper positions are still way long. And that's where I'm really, to me, that's my next axe to grind in commodities. Yeah, crude oil, I think it's a matter of time. It gets to 40, that's just normal. But copper around almost, $10,000 a ton, almost $4.30 a pound, looks to me way expensive. To me, that's the risk, is that autocorrelated metal goes down rather with bond yields.
Interesting. Okay. Well, I mean, you've talked a lot about copper's role as the kind of the bellwether for the global economy. We're seeing this U.S. unemployment rising, falling interest rates, but copper's been struggling. So Talk to me a little bit about this global economy, where it's heading. What are you seeing here? What's the insight?
Well, you nailed it, Jimmy. U.S. unemployment rising, interest rates declining, the inverted yield curve and disinverting. Those are really bad signs for copper. And then you always just, the bottom line I like to do, if you just take that per pound price of copper, $3.35 a pound, and overlay it, the U.S. 10-year note at 373, implies the copper price should be below 4, around 373. And if you add the Chinese 10-year note 2.04, whoa, you have closer to 3. So copper is very closely correlated oftentimes with interest rates. And interest rates are declining, bond yields are declining for a reason, because they're sensing deflationary forces. And to me, on a global scale, that is where commodities are clearly, there's no doubt, pointing out the trend is towards a global recessionary, deflationary contraction. And just look at gold's up 35%, 37% in 1 year basis. The Bloomberg Commodity Index is down 2%. Crude oil's down, iron ore is down, the grains are down, natural gas is bopped. So that, you need something to change. And I don't think things are going to change overnight in China, meaning some kind of, yes, so we fully expect fiscal monetary stimulus, fully expect them to buy more of their equities through ETFs. But it's the macro that matters. And that's why I keep focusing on the next key shoe to drop, I think, for all commodities, all risk assets, is we just get a little back and filled beta, means the U.S. stock market, which is normal as you approach a contentious election. And when you're really stretched, just a little normalization. To me, that's the next trigger I'm worried about. And that's why I think copper is more likely to head towards $3 a pound than go up towards above 5.
Interesting. It's so fascinating to watch the S&P almost be an inflation gauge these days. I want to sit and talk about copper just for one more second, because I had this person, a good friend of mine who runs a copper company, and he was talking a little bit, it was on the mining side, but he was talking a little bit about how there's so much narrative in the industry, and he's almost seeing copper face competition from other industries, such as like lithium and cobalt, due to this whole energy transition. You know, do you think that that's why copper isn't gaining as much traction here, or it's more fundamental and based on economies, like you said?
I think it's much more China. You pointed out the substitution factor, particularly when prices get low enough. Aluminum can be a decent conductor, not as good as copper. But to me, the way you started that segment there, I think is most important. The U.S. stock market cap to GDP is 2 times GDP. About $60 trillion is the stock market cap. That's the most in about 100 years. It would be silly to think that's not the most significant factor in inflation or deflation. There's a relative upward movement or downward movement of the U.S. stock market. So when I rope in copper, copper, let's point out some of the bullish points about copper. Copper made a new high in 2022 around Russia's invasion of Ukraine, and crude oil did it. Copper made a new high this year, and crude oil didn't. So I think it shows you the tilt. The metal is probably going to continue to beat the fossil fuel, but in the macro, it's stuck right in the middle there. And when I look at bond yields in China plunging, and all the data I see in the terminal about the property crisis, and every country in the world doing everything they can to get out of China, and NATO's comment that President Xi was a significant enabler of the war in Ukraine, makes me understand why copper should continue to meet the risks are downward. And that's why I have to resort to, here's why I like to end it is, there's an inordinate burden right now in virtually all risk assets, most notably in commodities, crude oil and copper, for the U.S. stock market to stay elevated. Because it's been going up a lot, crude oil is going down, copper's just kind of hovering. If the U.S. stock market just backs up a little bit, the dominoes tumble. That's what I'm worried about, is the next big trade.
Yeah, absolutely. And you mentioned, China's economy is struggling, especially in manufacturing. We're seeing cooling demand. How much of a drag do you expect China to be on commodities moving forward? Because there's obviously still people that are kind of hoping that this Chinese stimulus will come. And if that were to happen, could we see a resurgence in demand for commodities like copper and oil?
We will get stimulus. It's a matter of time. It's a matter of how much. And hope's never been a good trade. At least that's when I used to have hair trading. That's the problem. The fact that they have to depend on stimulus for stabilization, the fact that we have to depend on OPEC to increasingly add to its spare capacity and cup supply for crude oil to rise is part of the major problem in commodities. So those are part of the trading things that you fully expect, and that's part of the reason as a trader need to be nimble with crude oil having sold out completely. I think traders are more kind of waiting for a bounce to sell into, particularly if we have more signs of stimulus from China, which we will have. They kind of have to. But the macro big picture is overwhelming. And that is, I look at China, as I've been pointed out for years, is very similar to peak Soviet Union and peak Japan almost 30 years ago. The thing is, it's just much bigger, much wider, and President Xi, I think, made the mistake of cozying up to the wrong dictator.
Yeah, certainly lots of hugs being given. Okay, as we wrap up, we've talked about a lot. Looking ahead to Q4, what's the one commodity that investors should watch most closely and why here, Mike? I mean, we talked a little bit on the macro side, but what are you watching closely for these signs?
Well, I can't, we know where we're going with this one, gold. I mean, closely, because I have to admit, in the commodity space, it's nice to have something that's going up. And it's the only major commodity that is going up. I expect to continue to go up and has major sound fundamental and technical underpinnings below it. Again, to me, the bottom line for gold is just look over at Cold War 2.0 is getting hotter every day. The unlimited friendship between President Xi and President Putin is just kicking in. Bottoming, we have U.S. stock market volatility bottoming versus high T-bill rates bottoming from multi-year lows. And when that happens, gold usually outperforms. And just look at one key fact. The last time the Fed started easing in 2007 from similar levels, a year later, the S&P 500 was down 20% and gold was up 20%. Now, typically outperforms S&P 500. I just measured the last start of easing cycles since 1989. Gold usually beats the rock and is really beating the rock. So I look bottom line, it's gold. I expect some bucking in that bull market, but I'm really concerned when you see the rock beating stocks on 1, 2, and 3 year basis, and there's so much enthusiasm for the equity market. The key thing I like to point out is just a little bit of reversion in a really expensive stock market, most notably versus gold, and gold just catching up to the stock market as a curve disinverts, as the Fed starts to ease and the U.S. tilts towards this recession that's been completely elusive, is the current trajectories. I'm more fearful that it's going to accelerate.
Yeah, well said. And I mean, people just looking to take a little bit of profit, understanding when this is coming next here too, I suppose, on the equity side for the S&P. Valuations are nuts.
Yeah, well, here's key facts. Versus S&P 500, the Bloomberg Commodity Index is the lowest in about 25 years. The S&P 500 versus the rest of the world stocks, the MSCI ex-US index is the highest ever. Versus gold, the stock market's the highest since about 2007. Those are just basic measures of other markets. And I look at it versus a 100-week moving average, it's very stretched. Here's a key thing I like to point out. This metric made me a lot of money in 2008, and that is just look at the VIX Volatility Index. It's 52-week moving average minus the T-bill rate. That volatility measure is the lowest since 2007. That gave me the signal for the 2008 crisis. And the bottom line to remember is volatility is always mean reverting. The volatility in the stock market being this low is probably much better for people to consider profit taking, which they probably are. And I think that's part of the reason we're seeing this migration towards the rock metal.
Yeah, well said. Yeah, Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence, joining us today. Mike, thanks for this. Always breaking through all the noise, maybe even an opportunity to make some money there at the end. So hopefully the viewers waited for the entire interview this time. Thanks, Mike. Appreciate your time today, as always.
Thank you, Jeremy.
Thank you. I'm Jeremy Szafron for all of us here at Kitco News. Thank you for watching. We got great content all week long, so stay tuned and we'll see you next time.